In the previous section, you explored what real estate value is and the economic principles that shape it. You learned that value is not random. It emerges from income, appreciation, use, tax benefits, and the broader forces of supply and demand, substitution, and highest and best use. Now we move one step further into the practical side of the business. How market value is actually estimated, tested, and documented through the appraisal process. In today's real estate market, understanding appraisals is essential for every salesperson. While you may not perform appraisals yourself, you will constantly read them, explain them to clients, and respond to them when a lender's appraisal comes in higher or lower than expected. Appraising market value is all about answering a central question. What would a well-informed, willing buyer pay and a well-informed, willing seller accept under fair conditions at a specific moment in time? Market value and market value is an opinion of the price that a willing seller and willing buyer would probably agree on for a property at a given time, under typical, fair conditions. These conditions include a cash equivalent transaction, adequate exposure on the open market, and both parties having full information about the property and the surrounding market. Neither party is under abnormal pressure to buy or sell. The transaction is at arm's length, and the title is marketable and transferable. The price does not include hidden influences such as unusual concessions, special financing, or side deals that would artificially raise or lower the stated price. Another way to express this is that market value is the highest price a willing buyer will pay and the lowest price a willing seller will accept when both are knowledgeable, reasonable, and not distressed. Market price, on the other hand, is the actual amount the property sells for. In a perfect world, market price and market value would be identical. In reality, they often differ because the actual transaction may involve some form of distress, imbalance of information, unusual concessions, or timing pressures. A property might sell below its estimated market value because the seller is relocating quickly, or above market value because buyers are competing aggressively in a tight market. As a salesperson, part of your role is to help clients understand that a closed sales price reflects the unique story of that transaction, while market value reflects a broader, more objective analysis. Fair market conditions. For market value and market price to align, the sale must occur in what is often called a fair market. Fair market conditions require that neither buyer nor seller is distressed, and both have sufficient time and information to act thoughtfully. A distressed buyer might be someone who must purchase immediately due to a personal emergency. A distressed seller might be threatened with foreclosure or bankruptcy and willing to take almost any offer. Fair market conditions also require adequate market exposure and a negotiated price reached through mutual agreement rather than pressure. Consider a buyer upgrading from one home to another. They have time, have researched the neighborhood, reviewed sales data, and hired an experienced agent to help. The seller is a builder who is financially stable, has sold many homes in the area, and understands comparable sales. The buyer makes an offer, the builder counters, and after some negotiation, they agree on a price that reflects current market data. This is a good example of a fair market transaction where the final price closely represents market value. The appraisal and its uses. An appraisal is a professional, supported opinion of value, prepared by a neutral, qualified third party. While most appraisals aim to estimate market value, they can also target other types of value, such as investment value, insurance value, or assessed value, depending on the assignment. What distinguishes an appraisal from informal estimates is that it is based on systematic data collection and analysis, and is performed according to professional standards and state regulations. Appraisers are trained and licensed professionals who must follow industry standards, such as those contained in the Uniform Standards of Professional Appraisal Practice. They are expected to be disinterested, meaning they do not have a financial stake in the outcome. This neutrality allows lenders, investors, and courts to rely on their opinions when making decisions. Appraisals are used in many situations. Mortgage lenders rely on them to determine whether a property is adequate collateral for a loan. Government agencies may use them for tax, condemnation, or public project purposes. Investors may order appraisals to estimate value before acquisition or disposition. Buyers and sellers use appraisals to help set listing prices, evaluate offers, determine fair rental rates, and confirm that agreed-upon prices are reasonable. Insurance companies may also reference appraisals when setting coverage limits. For many residential mortgage loans, the appraiser's findings are reported on a standardized form called the Uniform Residential Appraisal Report, often referred to as the URAR. This form, used widely in conventional lending, organizes data about the subject property, comparable sales, neighborhood conditions, and the appraiser's analysis into a consistent format that lenders and underwriters can review efficiently. Broker's opinion of value versus appraisal. Real estate brokers and salespersons frequently prepare their own estimates of value to help clients. These estimates are often called brokers' opinions of value or comparative market analyses. They might look similar to an appraisal at first glance because they consider comparable sales and current listings. However, they are not the same thing. A broker's opinion of value is typically prepared by a party who is not neutral, since the broker often has a direct interest in listing or selling the property. The broker's opinion usually relies primarily on the sales comparison approach and does not apply the full range of appraisal techniques. It is not regulated to the same degree as a professional appraisal and does not have to conform to appraisal industry standards. This does not mean a broker's opinion of value is not useful. In fact, it is a core service that salespersons provide to sellers and buyers. It simply means that when a lender or court needs a formal, impartial opinion of value, a licensed appraiser's work product is the standard. As a salesperson, you need to be clear with clients about what your opinion represents and when a full appraisal is required. The appraisal process. Professional appraisers follow a systematic process to develop their opinion of value. Although this process is often shown as a step-by-step list, you can think of it as a logical flow of decisions and analyses that build on one another. The process begins by defining the appraisal problem and the purpose of the assignment. The appraiser identifies the subject property, usually by its legal description, and clarifies exactly what interest is being appraised, such as fee simple or a leasehold interest. The appraiser identifies the type of value to be estimated, such as market value, and determines the effective date of the valuation. The purpose might be to establish value for financing, for sale, for litigation, or for investment analysis. Once the problem and purpose are clearly defined, the appraiser collects, organizes, and analyzes relevant data. This includes data about the property itself, such as physical characteristics, condition, layout, and improvements, obtained through inspection, drawings, and public records. It also includes market data about the neighborhood, community, and region, such as recent sales, economic trends, demographic shifts, environmental conditions, zoning regulations, and construction costs. With sufficient data in hand, the appraiser evaluates the property's highest and best use. This step asks, under current legal, physical, and financial constraints, what use of the property would produce the greatest return? The answer may or may not be the current use. For example, a small home on a busy corner may have higher value as a retail site than as a residence. Next, the appraiser estimates the land value, typically by comparing the subject site to recent sales of similar sites without improvements, and then adjusting for any differences. Land is valued separately because the building may be newer or older than comparable structures. But the land itself must still be analyzed on its own merits. The appraiser then applies the three classic approaches to value: the sales comparison approach, the cost approach, and the income capitalization approach. Not every property requires equal reliance on all three methods. A single family home in an active subdivision may be best estimated using sales comparison. A new special purpose building may call for heavy use of the cost approach. An apartment complex will often hinge on the income approach. Using more than one approach helps establish a range of values and reduces the chance that a single unusual data point will skew the conclusion. After applying the appropriate approaches, the appraiser reconciles the different value indications into a final value estimate. Reconciliation does not mean taking a simple average. Instead, the appraiser weighs each approach according to its relevance, the quality of the data, and the nature of the property. For example, if the income data are weak, but the comparable sales are strong, the sales comparison approach may carry more weight in the final opinion. Finally, the appraiser assembles the results into a report in the format requested by the client. This may be a narrative report for complex assignments or a form report such as the URAR for typical residential loans. The report explains the reasoning, data, and conclusions so that a reader can follow how the value opinion was developed. Market value and replacement cost. It is important to distinguish between market value and replacement cost. They are related but distinct concepts and are estimated using different criteria. Market value, as you have seen, is the estimated price a property would bring in a fair and open market between a willing buyer and a willing seller. It usually includes land, site improvements, buildings, and sometimes personal property or intangible components, depending on how buyers in that market think about the property. Replacement cost, in contrast, is the estimated cost, at current prices, to construct a building with equal utility to the existing building, using modern materials and methods. Replacement cost focuses on what it would take to reproduce the function of the improvements, not what buyers are willing to pay for the entire property in the current market. It typically does not include items such as demolition and debris removal of the existing structure, changes needed to meet newer building codes, or extraordinary soft costs. Both market value and replacement cost are affected by economic conditions. When the supply of housing is low and demand is high, market values rise. When the cost of labor and materials increases, replacement cost also rises. The two measures often move in the same general direction, but there is no requirement that they be equal. It may cost more to rebuild a 100-year-old home than its current market value because buyers in that area simply will not pay enough to match the rebuild costs. Market value, market price, and fair market transactions. Market value usually differs from the simple market price, unless all the conditions of a fair market exist. If either party is distressed, under pressure, or poorly informed, the price paid may be higher or lower than the property's true market value. Imagine a buyer who has done careful research, viewed multiple properties, and is not in a rush. At the same time, imagine a seller who is financially stable and aware of recent comparable sales. The buyer and seller negotiate based on data and experience. If they reach agreement under these conditions, the final price will likely match market value closely. On the other hand, if a seller must close quickly due to a job transfer and accepts the first offer, that price may not reflect full market exposure and might fall below what a typical patient buyer would have paid. Cost, price, and value. Clearing up the confusion. People often use the words cost, price, and value as if they mean the same thing. But in real estate, they describe different ideas. Cost is the amount of money it takes to produce or acquire something. Price is the amount of money actually asked or paid in a transaction. Value is a supported opinion of worth in a specific context. Consider John, a buyer who has made an offer on a 3-bedroom, 1-bath home for a certain amount. The cost to John is the money he will pay at closing. The price is the amount the seller is asking in the listing, or the amount the parties ultimately agree on in the purchase contract. Cost and price are objective numbers. Value is more complex. Value is an opinion of worth based on facts, such as comparable sales, neighborhood trends, and property characteristics. An appraiser's job is to determine market value, the most probable price under fair market conditions. This may differ from what John offers to pay or what the seller initially lists the property for. A seller may overprice a home due to emotional attachment, or a buyer may be willing to pay above market value to secure a particular home in a competitive market. Other professionals also think about value differently. For example, an insurance company may estimate the cost to rebuild a home in case of a total loss, and that rebuild figure may be higher than the home's market value. Investors may evaluate value based on income and expenses. They view the property as a business, not simply a personal residence. Because they need to make a profit, they may be unwilling to pay what an owner-occupant would pay, resulting in a lower investment value than market value. As a real estate professional, you must be able to explain these differences. Cost is what it takes to build or buy. Price is what is asked or actually paid. Value is a reasoned judgment, supported by data, about what something is worth in a particular setting. Review summary. In this section, you learn that market value is a supported opinion of the most probable price a willing and informed buyer and seller would agree upon under fair market conditions. You distinguish market value from market price, understanding that actual sales prices may be higher or lower than market value due to time pressures, distress, or unusual terms. You also explored the role of appraisals as formal, professional opinions of value prepared by neutral experts following a structured process. You saw how appraisals differ from brokers' opinions of value, which are useful but not neutral or regulated in the same way. You walked through the appraisal process, from defining the problem and collecting data to analyzing highest and best use, valuing land, applying the 3 approaches to value, reconciling the results, and reporting the final conclusion. Finally, you clarified the differences between cost, price, and value, and examined how market value, replacement cost, insurance value, and investment value may all differ depending on who is using the property and for what purpose. Discussion. Why might a property's market price differ from its market value? Answer. Market price may differ from market value if the transaction does not occur under fair market conditions. For example, if a seller is under pressure to sell quickly or a buyer overpays due to emotion or urgency, the price may not reflect what a well-informed, unpressured buyer and seller would agree upon after adequate market exposure. How is a broker's opinion of value different from a professional appraisal? Answer. A broker's opinion of value is usually prepared by a party who has a direct interest in listing or selling the property, and often relies mainly on comparable sales. It is not regulated to the same extent as an appraisal and does not have to follow formal appraisal standards. A professional appraisal is performed by a neutral, licensed appraiser who collects and analyzes data systematically and produces a supported opinion of value according to industry standards. Why do insurance companies sometimes assign a higher rebuild value than the property's market value? Answer. Insurance companies focus on what it would cost to rebuild the structure using current materials and labor, which can be higher than the price buyers are willing to pay in that market. Market value reflects buyer demand, while rebuild cost reflects construction realities. In older or less desirable markets, the cost to rebuild may exceed what the market will support in a sale. How might an investor's view of value differ from that of an owner-occupant? Answer. Investors generally view property as an income-producing asset and base their value judgments on rent, expenses, and required return. They may assign a lower value to a property if the income does not meet their investment criteria. Owner occupants may place higher value on personal preferences, neighborhood amenities, and lifestyle factors, and may be willing to pay more than an investor would. Closing remarks. Appraising market value connects the theory of value to the realities of today's real estate business. As a salesperson, you will constantly interpret appraisals, prepare your own value opinions, and explain the differences between cost, price, and value to your clients. When you understand how appraisers think and how market value is developed under fair conditions, you become a more confident advisor. In competitive markets, this knowledge helps you price listings accurately, counsel buyers on realistic offers, and navigate conversations when an appraisal comes in above or below expectations. This understanding forms a bridge between your earlier study of value principles and your day-to-day work in pricing, negotiation, and client representation.